Welcome to our training on the investment stages of private equity. This is a topic that is crucial to your understanding of the many different rounds of financing possible for private equity investments. This video will help you to understand the basics of each stage as well as the sequence they are in. The investment stages of private equity are seed money, startup funding, first round financing, second rounding financing, mezzanine financing, and bridge funding. One must note that not every company will require each stage of financing. Seed financing is financing at the beginning of a company. Seed money, sometimes known as seed funding, or friends and family funding, or angel funding, is a securities offering whereby one or more parties that have some connection to the new enterprise invest the funds necessary to start the business so that it has enough funds to sustain itself for a period of development until it reaches either a state where it is able to continue funding itself, or has created something in value so that it is worthy of future rounds of funding. Seed money refers to the money invested. New seed money options are also emerging from crowdfunding. Usually at this point, the company hasn't produced a product yet, but has an idea of what it is they are going to produce, and they also have a loose management structure. Seed money is typically used to pay for such preliminary operations as market research and product development. Investors are often the business founders themselves, using savings, mortgage loan proceeds, or funds borrowed from family and friends. There may also be outside angel investors, venture capitalists, or accredited investors who are acquainted in some way with the founders. Seed capital is not necessarily a large amount of money. Many people start up business ventures with $50,000 or less. Seed capital can be distinguished from venture capital in that venture capital investments tend to involve significantly more money, an arm's length transaction, and much greater complexity in the contracts and corporate structure that accompany the investment. Seed funding involves a higher risk than normal venture capital funding, since the investor does not see any existing project to evaluate for funding. Hence, the investments made are usually lower, as with normal venture capital investments for a similar level of stake in the company. Startup funding is financing that is needed for early stage firms that have expenses for marketing and product development. This funding is used after the product idea has been initially developed to further refine it and begin to market it. The next round of financing is first round financing. This stage occurs immediately before the company begins to produce a product. The purpose of this funding is to further develop the management team, further develop the product, and demonstrate that the business is going to be successful. This financing is often provided by angel investors or smaller venture capital funding. It is important to understand first-round financing, as there are different nuances to consider depending on whether you're talking about a PIPE fund, private equity firm, angel investors, or hedge fund investors. These investors tend to use different structures and have even different exit strategies. You have to think of financing like a chess game. You have to think 2 or 3 steps ahead. Most companies don't raise venture capital financing in one round without the need to raise financing in 2 or 3 subsequent rounds. First round financing, therefore, becomes important for several reasons. 1. If you give away too much equity, your company's common or preferred stock, in the first round, you have greatly diluted the ownership position of the management team. For instance, if you give up 45% and you are likely going to need subsequent financing, then the result will probably mean giving up voting control of the company to raise more capital. Of course, if you can convince subsequent round investors to give you super preferred voting rights, then you may be able to maintain voting control, even if you lose majority ownership in the company. 2. Venture capital firms typically like to control the whole deal. This means if you give up too much in the first round financing, you will be at their mercy in subsequent rounds. They will take advantage of the fact that you are desperate for more cash for the company. They will also have the deal structured, so if you refuse to give up control in the subsequent financing round, they will be able to take over the company and replace management. They can do this by structuring the financing terms with a number of different default clauses. And 3. Another problem with not understanding all the implications of first round financing is that it can restrict your ability to raise subsequent financing. For instance, let's say you and the investor or investors that provide the initial funding have a disagreement and you decide to go elsewhere for more funding. This second round investor is going to look at all the documentation of the initial funding you received and may even want to talk to the first group that funded your company. There may be restrictions on subsequent rounds that scare away other investors. I am talking about restrictions like rights of first refusal, security agreements that run in favor of the initial investors, and clauses that prevent you from giving other investors more voting control or a better stock purchase price than the first investor group. Second round financing occurs after the company has produced and sold its product. The purpose of this round is to strengthen the balance sheet and provide a financial base to solicit further bank loans. It is also used to further develop the marketing plan and establish strategic alliances in the market. Mezzanine financing is the funding that is used for a company that is somewhere between a startup and before an IPO. It is used in expansion money for a company that has already proven profitable and can facilitate an M&A activity or refinancing within the company. At this level of funding, the risk for the investor goes down, but so does the level of expected return. It is a hybrid of debt and equity financing that is typically used to finance the expansion of existing companies. Mezzanine financing is basically debt capital that gives a lender the rights to convert to an ownership or an equity interest in the company if the loan is not paid back in time and in full. It is generally subordinated to debt provided by senior lenders, such as banks and venture capital companies. Since mezzanine financing is usually provided to the borrower very quickly with little due diligence on the part of the lender and little or no collateral on the part of the borrower, this type of financing is aggressively priced with the lender seeking a return in the 20 to 30% range. Bridge financing is a round of funding that is used to solely bridge the gap for a company to go public. This funding is used to fund all the costs associated with the IPO process and maintain the necessary liquidity for company operations. There are two types of bridging finance: closed bridging and open bridging. Closed bridging finance is where you have a date for the exit of the bridging finance and are sure that the bridging finance can be repaid on that date. This is less risky for the lender, and thus the interest rate charges are lower. Open bridging is higher risk for the lender. This is where the borrower does not have an exact date for the bridging finance exit and may be looking for a buyer of the property or land. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.